This conference will now be recorded.
Good evening, ladies and gentlemen. This is Clueless Trading Frank on an absolutely beautiful, beautiful summer evening here on the East Coast on the New York City, New Jersey waterfront. It is 9:16 p.m. on July 14, 2019. This is a strategic weekend webinar, which are extremely useful, very resourceful, and very powerful setups, preparation for the coming week and the weeks following that. The session will be recorded, uploaded to the Google YouTube channel for Clueless Trading. Feel free to review it at your own time, hopefully sooner than later, before you start your trading week tomorrow. Full disclosure, this is purely for financial education, not for any solicitation or advice. So let us begin. So I'm going to start off by attempting to keep these sessions brief, to the point, and highlighting the most important aspects of the market and the most important catalyst which will drive the markets up and down. And then we're going to talk about some stocks. So first of all of you who have been tracking the progress here at Clueless Trading know very well that almost every single strategic forecast on the markets and certain individual stocks are going exactly the way we had mapped out. And I know many of you are taking full advantage of it. So congratulations to everyone. The markets are always the same. There are people there are traders and investors who are terrified of every move up and down, and I mean up and down. And there are traders and investors who actively engage with the markets to make money on opportunistic trades and deal with the volatility that comes with standard volatility that comes with being in the US financial stock markets. That's what we specialize in. So at this point, we are entering from a technical standpoint and also from a behavioral standpoint, which deals with retail investors, which is basically you and me, human traders, what I call the intermediate term final stages of wave 5. What does that mean? Wave 5 on Elliott wave theory in simple English means that this is the point where people start getting a little too excited about the stock markets because they have been sitting around on their butt doing nothing for months and months. They're seeing the markets making new highs despite all the issues with China, Europe, recessions, inverted bond deals, Fed Chairman Powell, interest rates, you name it. Just pick and choose what you want to throw at the market. The markets are climbing. It's what we're talking about from a technical standpoint. I've been talking about this, that we would be hitting 3,000 or getting close to it, and now we're above 3,000 on the S&P 500. These are monumental numbers, but there is no excitement whatsoever. Let's face facts. Okay, there is absolutely no excitement. There is no euphoria. There is absolutely no on the street. The common person is not screaming and shouting, "Oh my God, I want to buy Netflix, or I want to buy United Health, I want to buy Anthem Health." Huge winners that have been just breaking out. So that's a very good thing. So the good news is that there's still opportunities in individual stocks to go higher. Overall market certainly is getting overbought on a technical perspective. We're going to look at that. We're going to explain that very clearly. And we could get a sudden 3, 4, 5, 600 point drop within a matter of a day or two, which will basically bring in the fear factor again and push the late stage entries in the market, whether they be mom and pop or whether they be traders who have been either sitting on their butt doing nothing or trying to short the market on every 100-point move higher. They'll be entering, and then the algorithmic high-frequency trading bots, algorithmic high-frequency trading supercomputers are going to smash them. It is about to happen. And then the bigger picture of the market is higher. But short term, we are reaching, I repeat, pretty serious technical levels. And within a matter of days, in my opinion, you're going to see some pretty substantial pullbacks. Days or maybe a week or two. So be prepared for that, because I am. We have gone through serious movements in the market where we have dropped we have woken up in the morning with markets down 400 or 500 points, and we have still made money on those environments. You all know that. It's all there on the private real-time Twitter feed, Clueless8RT. As members and free trial subscribers, you guys are privy to that. All that information, everything is put in a visual format. Trade alerts are put out there. And then in between, you guys have to know how to manage your trades. That's the tough part. In my opinion, that is one of the toughest parts, because it is not where you get in, it is where you get out, and most importantly, when are you getting out and seeing the same trade just catapult higher on, from the option standpoint, another 100, 150, 200%, in some cases more. And that's a very tough pill to swallow. We are all guilty of that, but you need to improve your trade management skills to basically jump back in again as the charts are moving, as the alerts are going, as you are learning how to do this business, and go with it. There'll be losses along the way. Losses can always be turned into winners, in my opinion, in most cases, either through buying a different set of options in a different company, or trading the same options or as the reversals happen. Reversals are monster winners. I would like you all at your own time review the new member intro session that I had this morning, where I highlighted the case of something that I alerted, told you guys to buy it again after it dropped after earnings, and then the calls just went berserk. So the stock, Price Smart, PSMT. So please, the whole explanation and the visual options charts and stuff are there on the video that was put out there early this afternoon. So please feel free to review that. Reversals, these are the type of trades that are happening in the market. Momentum trades, which are basically breakouts, either to new highs, what we call ATH, all-time highs, or breakouts out of ranges towards new highs. We have shown a large amount of them. You have to be in it to win it. These HMOs, they are basically on the major breakout stage. Whether they're going to hit the new all-time highs, I'm talking about United Health, I'm talking about Humana, I'm talking about Anthem, and a bunch of other biotech trades. But these three specifically, the funds, the big boys, are in them hard. They were buying them along the way, as I said before in many of my webinars and my charts, that these are the ultimate swing trades, just like Chipotle was when it was at 250 bucks. Where is it now? Almost closing into 800. How long was it? Less than a year. Far less than a year. So this is what happens. So there are reversal trades, there are momentum trades, there are earnings. I have a very good description of how to play the earnings things using the basket strategy in the early afternoon, today's video that was put out there, which is the new member options trading video. So please review that. So momentum trades, earnings trades, reversal trades, some short trades, primarily through the SPYs on intraday pullbacks or overnight pullbacks. These have to also, we take advantage of them as much as we can. But where the primary trend is significantly higher, it's tough to go to bed with a huge amount of shorts, because you wake up the next morning completely decimated, as you all know. So let's talk about let's talk about what is happening now. We are about to enter, starting tomorrow, we are entering earnings season. This is the second quarter earnings that are going to be coming out. Companies will be delivering their Q2, which ended on June 30th. Told you we'd have a strong finish, and exactly what happened. We had a strong finish. Okay, end of the second quarter, end of the month, which was June 30th. So tomorrow, which is Monday, 7:15, ER seasons, earnings reporting season begins. We start off with Citigroup. I'll give you the companies which are going to basically determine how this week shapes up. Each company, keep in mind, will be singing its own tune. If the banks overall don't do well, let's say Citigroup does well, Goldman Sachs croaks on Wednesday, you have Netflix on Wednesday, it doesn't mean that the whole sector, initially the whole sector will pull back a bit. That's obvious. But each stock will be determined by its own merit. What their guidance is, what they did, what they see, what the impact of this trade war is all about, impact of low interest rates, what it's all about, and all that good stuff. So we start off with Citigroup, very important barometer of the overall health of the US consumer because of their large credit card operations, banking operations. That starts off tomorrow before the market. How timely, huh? So we are entering earnings season. What else is critical? Obviously, the ongoing China trade talks. So far over the weekend and on Friday, Treasury Secretary Mnuchin said that he's talking to his Chinese counterpart and they're looking to fix a date to fly there. So China trade, very, very important. I've always believed, and I still believe, that in between all the shenanigans and all the tweets from President Trump and all the tough comments out of China, the trade deal will be done. It is never going to be a perfect deal, just the way in life there's nothing called perfection, right? It's just about a solid, constructive compromise. And the market's basically just nervous as hell for every little headline that comes out that way, which is called volatility, which we manage very well, primarily because we focus on charts. So we have the China trade stuff we have to monitor very closely. The fourth major catalyst to the market is Fed speakers. Now, we have already heard from Chairman Powell. He is very supportive of keeping the U.S. economy growing. We have the FOMC, Federal Open Market Committee rate meeting on, I believe, on July 31st, Wednesday, July. So mark that date, July 31st. I believe that the markets will overall continue to go higher till that week. Now, is he going to cut 25 basis points? That means quarter of a percentage point on the Fed funds rate. Will he tinker around with the other rates, which are the discount rates? Don't want to get into all that. You guys can read up on what those are. But those are the rates that determine the overall the overall rate environment, interest rate environment in the U.S., which is extremely important. Or whether they'll cut half a percentage point, there's a whole bunch of debate and betting by the big shots. My opinion is that they're going to cut rates by 1/4 percentage point. Now, what determines that? They'll certainly cut rates. I don't think he's going to go back on his word. Now, if he doesn't cut rates, then the markets are going to fall 500 points the next day or the same day. That's it. That's a done deal. It will happen if they don't do anything. Now, what determines this is the health, the numbers coming out of the U.S. economy, the inflation numbers, all the GDP numbers, gross domestic product, also the numbers to do with industrial goods and manufacturing. If we get into another major nasty back and forth with China, markets will obviously pull back and the Fed will be more open to cutting rates by 0.5 percentage points. Because at that point, the danger in the US and for the global economy, remember, we're all interconnected, whether one likes it or not. 80% of the US companies, the large companies, their revenues come from selling our finest products to the world. So you want to chop their legs off? Well, good luck. You're chopping the legs of the US. Okay? So it's time to wake up and understand that, whether one likes it or not. We are a global economy. We're a global superpower. Military and economic, all tied in. Economic means our economy and our financial markets, both. So you chop off one of them, ain't good. So if the economy is running too hot, meaning things are really picking up, inflation is picking up, that means the prices of goods overall, and manufacturing overall starts to pick up. That's actually great news, but that means the Fed is going to be less inclined to cutting rates 50 basis points. They'll probably give us a 1/4 percentage rate cut and then determine what happens after that. So that's basically it. That's all you really need to know to be half smart and manage your trades accordingly. That's the big picture behind the scenes. Just to keep it within some specifics. Any questions? Any questions? Anyone? No? Okay, sounds good, Mary. Thank you. So now let's get into the charts. Actually, before we get into the charts, let's go through what I actually walked you all through in a very detailed manner, which is talking about what's coming this week. I did that last Sunday with all the Fed speakers and all that stuff. And I did say that overall, unless Fed Chairman Powell completely did a U-turn and became bipolar and said, "That's it, I'm raising rates, forget it," the markets were going to just bust a move. And that's exactly what it did. They busted a huge move repeatedly. And I repeat, the sentiment is still overall bearish. Like I like to say, the bulls are scared, the bears are terrified, and the market has more upside. Remember that. Right now, the overall sentiment, bullish investors, that includes all of us, because we are technically looking at the markets from how it's moving higher. Even when days were way down or weeks were way down, I've walked you guys through what we need to watch for. My advanced coaching students know exactly what I talk about and what I put out there. They know how to read those charts to a high degree of understanding, so they don't flip out and sell at the wrong time. They buy those tactical dips 400 points down on the market, and then they have the shooting the fish in the barrel moments when the next morning the futures open up 10-15 points and their stocks, which they bought on the cheap, are running like crazy. We have done this repeatedly, ladies and gentlemen. And I don't buy just any dip. We're not in the BTF decap, buy the F dip. That's the stupidity of other services and other forums They're like, oh, buy it. It's definitely everything's going higher. No. We don't do that. We measure the overbought, oversold conditions through various indicators. We look at the overall candle structure. We look at the patterns, whether it's still a bull flag, whether it's a falling wedge, whether it's this or that, whether it's a range bound, and then we go in. We don't just blindly go in BTFD. That's for idiots. This is not a frat party, ladies and gentlemen. This is real life trading. This is my real life living. This is what I pay the bills on, and the debts, and my kids' tuition, and the cars, and the house, and God knows what else. Oh, and the pets. How could I forget that? Okay, 6 of them. All right, pretty expensive, I'll tell you that, with their insurance, with their health care, and their food. So, all right. So basically, the bulls are scared. That means all of us certainly are. But fear doesn't have to be a bad thing. You can turn it into a positive event. Listen, I'm basically a Boston, New York guy, okay? And we live on stress. Stress keeps us going. Stress is what built this great nation of ours. This glorious nation of United States of America wasn't built on complacency and fear and sitting and SOA, sitting on you know what. It was built on stress, on risk, and speculation. Every great city in America was built on speculation. Let's go do it. Just do it. And then things happen. And in between, there was a lot of heartbreaks. So trading's the same way, guys. All right? You want real complacency and like a soft ride, a walk through the park and a nice cup of coffee on a beautiful day. Well, don't be an options trader. Go buy a stock, you'll be up like 20% in 6 months. Like, okay, great. If that excites you, great. You're in the wrong service. We're in the business of making 20, 50, 100, 200% on options trades, taking our hits, moving along, making 3 times more on the other side. We have had options trades which are up 1,000% plus just within the past week. So bulls are scared. The dogmatic bears. Remember, you can certainly be bearish. I mean, I'm like getting tactically bearish on the markets overall. I am, as I explained in the first part. So the bears are terrified because every time the market's dropping, these hardcore so-called smart money are forced to cover, and we have these massive short squeezes. The market turns around after reaching certain levels, and boom. Those little short that we did on the SPY the other day, the calls went up like 30%, and right there, it hit one of my levels and turned around, and the machine started to boom, started creating these big red candles, and the market just turned around, just went higher. Why does it happen? Just because it happens from hot air? No, it happens because the big short funds are getting squeezed big time. Squeeze, and it's not a nice squeeze. A short squeeze is not like you're giving somebody a hug. A short squeeze is when they are losing money. Most institutions and hedge funds are still, believe it or not, short the US economy and believe that we are going to fall into a hardcore recession. I don't know whether we're going to fall into a recession or not, but overall, given what we see, given that we have, and one of the biggest reasons the bond market are, the inverted yield curve, which basically started to fix itself, given the fact that the rest of the world, almost the government bonds have negative rates. That means if you hold it for, let's say, 10 years or 15 years, whatever the duration of that bond is, you're actually going to lose money. So you go to your bank, for example, and they say, oh, I'm going to give you 3% negative rate. So if you put $1,000 today, then on a 3-year CD, not that it's ever going to happen in the US, in my opinion, but that's what's happening in a lot of other countries, developed countries like Germany and other places. So they have negative yields. So basically, by the end of whatever the term is for your CD, you are going to get $1,000 minus $30, which is 3%. So you're going to get $970 back. Would you like to do that? That's a major risk to the global economy, by the way. But why is the money hiding in there? That's another day story. Does everyone understand what I just explained? Yes, no, maybe?
Yes.
Good. Okay. That's your macroeconomic picture. But basically, this is what's going on. We all, including myself, have room for major improvement to capture 90% of these massive trades that I'm putting out there. 90%, not in return, like 90% of the move. So if they're up 2,000%, we should catch 90% of a 2,000% move, which is 1,800%. But in between, I'm not making 1,800% on some of these things. I'm taking some very nice profits, rolling them out and doing it, but I'm putting these trades out. So all we have room to move. We certainly have to be bearish at the right times, but overall, the market is still moving higher. End of story. Let's move on. So let's get into the economic, oops, sorry. All right. So here are the most important things coming up. Monday, July 15th. Let's get a nicer color. Let's get green. We like green. So you got the bond settlements and all that stuff. Empire State Manufacturing Survey, that's in New York, which is a major industrial state. 8:30, that's an important one. Fed speaker, John Williams, not the Boston Symphony conductor, okay? So John Williams speaks, 8:50 a.m. Important, because what they say, but we heard from the, remember, keep it simple. Let's keep it the KISS method, keep it simple, stupid method. Powell has openly said he's cutting rates. He's not looking to stop the U.S. economy from growing, despite all the criticism and the personal attacks on him by President Trump, which I'm always totally against, as you all know very well. And I think any decent person would be. Stop pissing on Powell. He's a great, smart American Fed chairman, nominated by President Trump himself, by the way. Okay, is not doing any harm to the U.S. economy. So let's just stay off his back. So bottom line is, John Williams is one of the Fed governors. So what he's going to say, yes, short term might move the markets a little bit, but Fed Powell is on a straight line path to cut rates, keep the U.S. economic expansion going. That's what we want. So as long as he doesn't change his tune, I'm okay with that. And if he suddenly changes his tune, I'm not going to be his big fan. I want people to help the U.S. economy. All right, I'm the biggest believer of the U.S. economic system ever. Unlike others, like I always say, wave little flags, but would never buy a stock or invest in our markets, which make us stronger. So then we go into Tuesday. We have retail sales, very important. 70% of the U.S. economy runs on retail sales, right? The consumer, you and me. I'm not a big shopper. If I was like the majority of the consumer, the U.S. economy would be broke because I don't really shop. Okay, so but this is what drives the U.S. economy. Let the retail sales flowing. The number has to be half decent. Import and export prices important. Inflationary number, not critically important. Industrial production, very important. How is the overall health of the U.S. economy going? As in producing hard goods. Business inventory is important. Housing market index important. Not that important unless the number really collapses. The housing market is moving along. Rates are very low. Yet the housing market hasn't really picked up in a big way, right? Exactly, because there's too much. There is a tight supply in certain cases. The prices are too high, and people are just too greedy for selling their houses. If you ask me, okay. So if they lower their prices, housing sales are going to go higher. New housing sales are going well on the starter homes and stuff. Then we have the Treasury and National. Forget about this stuff. So this is the most important number for Tuesday. This is the second most important number, third most important number. We get into Wednesday, hump day. Always the day. If we are up these days overall, you know what happens on Wednesday? We are down because that is the technical correction day. Options are reset for the weekly options. Remember, back in the days, we never had weekly options. Weekly options were introduced by the CBOE as event-driven options. That's a Chicago Board of Options Exchange, I believe 3 years ago or so, right? Or 4 years ago. And it was primarily designed to generate more revenues because the overall volatility in the market was rising, and hedge funds and many other major players in the market demanded that we have weekly options, so we didn't have to buy those monthly options because the world changes in a week sometimes. At least the market does. So that's why we have weekly options, which increases volatility in the market. That's why Wednesday is normally a reset day. So what's important here? The mortgage applications, again, and the housing starts. Beige book. You all know what the beige book is? And by the way, I would highly suggest that all of you have mics next time we have the webinars, because it's tough for me to conduct this fantastic strategic webinars that I do and then look at the dialog box and see comments that some members are putting in there, because I don't know what exact point they're putting in there because they're related to that. All right, like Mike says, CC. Mary, my good friend, says, laughing out loud, don't forget them. I have no idea who. Oh, don't forget them. I think she meant the pets. But I don't, like I said, I don't want to I don't have the capacity right now to analyze those comments that are coming through. So have a mic, say something. It's fantastic. It's interactive. It gets everyone going. So please just have a mic and just speak in. Much easier for me and great for everybody else. So, because tough for me to concentrate on reading the chat box on GoToMeeting and then conducting this serious webinar. I'm sure you all understand that. So beige book is basically going to be the overall health by the Federal Reserve. Beige book. I don't know why they call it a beige book. I'm sure there's a definition for it. And because maybe in the old days the cover of the book looked beige. But the beige book talks about what the Fed overall thinks about it, and that's important. That's very important. Now, will it be fundamentally different than what Jerome Powell and other Fed governors have spoken over the past couple of weeks or so? I don't think so. So the beige book generally is going to be, in my opinion, supportive of the comments that have come out from the Federal Reserve governors, and most importantly, the kingpin, the Fed chairman, Jerome Powell. But an important number, Wednesday. Thursday, we get into Thursday, July 18th. Jobless claims, important. Not critically important, but important. Philadelphia Fed Business Outlook Survey. This is similar to the Empire Manufacturing Survey. These are all measuring the health of the production capabilities of the U.S. and what's going on. Leading indicators, what we call back in the days, well, not back in the days, and it's this I learned in college, back in my, I was doing my MBA. So leading economic indicators, very, very important. Rest of them are the bond sales. Now, these are important because lately what's been happening is the demand to buy U.S. Treasury bonds is starting to fall. What does that mean? That means foreigners and U.S. participants, China included, believe me, China holds the largest amount of the U.S. debt because they have bought so many of our bonds and financed our deficit because we love to spend like frigging drunken sailors. I shouldn't say sailors because sailors don't really spend that much. They just get drunk a lot. Just kidding. I mean, I'm talking about like drunken shopaholics. Okay? So somebody has to finance that debt. So this is something on a long-term basis, not necessarily good, that people overseas, major bond market participants who love buying U.S. debt, are starting to slow down. Are they losing faith in the U.S. economic system? I don't know. I doubt it. John Williams again speaks. Now, what's going on? John Williams speaks here, then he speaks here. I mean, this like I guess he's in demand. That's important. So these are the most important numbers, and then John Williams, the Fed, one of the Fed governors, speaks. Friday comes around, consumer sentiment. You know it. This is a big one. Let's keep the consumer confidence, consumer sentiment going, because if this shows a sharp drop, the markets are going to croak right off the bat on Friday morning, pre-market. I mean, this is actually at 10 a.m., so it's not pre-market. James Bullard, another Fed governor, speaks. Baker Hughes rig count, doesn't matter. It used to matter a lot. That's oil rig counts, just so you know. And Eric Rosengrant speaks, another Fed governor. End of story. So just walked you guys through it. Any quick questions? Yes, no, maybe? Can somebody speak up and just say yes or no?
No.
Thank you. Appreciate it, Jill. Don't know why these charts are not getting populated. So their server must be slow because, okay, you need to mute your microphone a little bit. Thank you. All right, so let's take a look at, and again, this is the KISS, Keep It Simple, Stupid Strategic Webinar for myself and for everyone else. This is your longer term picture. I mean, this is your trajectory of the US markets. Right now, we're right here. This pattern, by now you guys should all know this. This pattern is known as a rising wedge. What happens to a rising wedge? Does anyone know? I mean, they should know because I've explained it a zillion times. What happens to a rising wedge? Come on, this it's not like Stanford economics, guys.
Usually a pullback.
Thank you. Thank you. Exactly. A rising wedge, usually a pullback, which is known as a profit-taking consolidation channel, also called the galloping horse. I call it a galloping horse because it looks like that. It's like this little wooden horses. If you're a kid, you're like on top, you know, just like riding it. That's serious, all right? And this is the part that can last for a couple of days and gets really tricky because we don't know whether the primary trend is going to continue higher or whether that rising horse, I mean, the consolidation channel is going to go lower, in which case multiple Fibonacci retracements and everything come into play. And you've got to focus on my charts like your life depends on it and you stop losing money. Because it could easily fall into a trading channel down here, in which case we are dropping a good solid 400 points. I personally think that's probably what's going to happen. It's going to be happening really fast. So don't sit there and cry. Be prepared. This is a rising wedge. The upper end of the wedge is 30.28. Let me just put the S&P 500 so we don't have to. Here's your S&P 500. Those are the E-minis, the actual futures. This looks like it wants to bust a move over this rising wedge, which is a sign of a very powerful bull market. It's been doing that repeatedly. Remember, this is a massive multi-month inverse head and shoulder consolidation channel breakout, all walked through, like I like saying, exactly as forecasted and alerted to all of you. I am not a raging bull. I am a very tactical bull and very prepared if things go the other way and the technicals change to short the market for days in a row. I am very prepared to do that. Flexibility is key. Changing your opinions depending on structural dynamics, on technical chart patterns is key. This is not the little high school, you know, prom party where it's like, why'd you change your mind? I thought you liked him. Well, your answer should be, well, he had a great job, but looks like, you know, he decided to smoke crack, so drop him, right? So exactly. So if the market starts smoking crack and technically things break down, I will turn more bearish than you guys even know. All right? And it's going to be like, oh, he was so bullish and now he's bearish. And I know some people will say that, but who the heck cares? Remember, other people's opinions don't matter. I live and breathe technical charts and the way I structured them. If something changes in this, and this is very serious what I'm saying, if something changes in them, I will change my mind in a millisecond. Because these charts are telling me huge amounts of information, huge amounts of information. Just the way those radio waves from Mars and other planets that are the Mars rover, for example, the Cassini rover, I'm big into astronomy, that landed there. It kept on sending signals till it disintegrated, till the last minute it disintegrated. That was the plan. It had to disintegrate. In the rings of Saturn, that was another one. Unbelievable. Okay, so the signals were coming. So the signals come from the charts, but the minute the signals turn, I'm going to turn. So you guys better be prepared in your head to also turn. But I'm not going to turn and change my overall directional bet on the market, overall direction of the market on mini consolidation channels. So at least this one is showing that that it looks like at least looking at the candle structure, it looks like it still wants to bust a move higher. Now, how much will it go higher? Go look at all my other charts all day long that I worked so hard to show it to you guys. I said S&P 3020, S&P 3030 would be possibly a level. I can draw it here as I've drawn in my other charts. If I draw a very bullish channel, then you are looking at S&P 3122. We are at 3017. That's 100 points higher. That means the market goes up 600 to 700 Dow points. That means we're almost hitting 28,000 on the Dow. Is that possible? Sure, it's possible. Do I think it's a high probability move? No. I would not be that bullish saying that markets are going to go to 700 points in the month of July. I would be looking at a mid, and just please look carefully, and you guys can all do this on your own. You have computers, you have a mouse to draw things. There. That's your mid channel. What is the mid channel? Can somebody tell me right now? What is that number? Please have some engagement.
3060? One?
Yeah, 3060. Thank you. 3060. So 3060 from where we are right now is more of a feasible move on some strong numbers or less weaker numbers or less weaker guidance. That's what it's all about. Companies give guidance, about, oh, okay, this is what we see, this is what we can do. That's called guidance for people who are new to the market. So if the guidance is okay and we have some blowout numbers, remember, we have Citigroup, we have Goldman Sachs, we have Domino's Pizza, we have United Airlines, all this week, starting off Monday. Wednesday, we have Bank of America. Wednesday night, we have Netflix, we have eBay, we have IBM. I highlighted some of them. That's why I'm reading off my other sheet. Honeywell, Morgan Stanley. So if they overall are saying, okay, we can manage this tariff war, we're moving production elsewhere, blah, blah, blah. American companies are the best things in the world because that's what made America great. So they're shifting production to other countries to avoid tariffs. Fine. The market will, at that point, extreme scenario, can go up 700 points by the end of July, or at least short term can go to 3060, as Mary correctly pointed out by looking at this. And somebody else should have piped in and just mentioned that too. So anyway, so 13, 17, 13, 16, wherever we are, 13, 13, 60. So you're talking about another 50, let's call it another 50 points. So 50 times about 7. Remember, one S&P handle is anywhere from 7 to 9 Dow points. So I look at the lower number, 7 conversion would be 350 points in the Dow. Is that possible? Absolutely. And we hit the mid-level. Now, keep in mind that the market is getting stretched and stretched and stretched, technically speaking. Now, what does that mean? For all of you who have been with us for a while and people who have taken the advanced coaching sessions know very well, and I have these explained in multiple excellent technical videos on my Google YouTube channel, we are moving further and further away from the highways. Those highways are your 34 and 50-day moving average that I follow very closely. The distance traveled, or we call standard deviation higher, as in getting more and more expensive. That's why we call it overbought. What does overbought mean? Things so short term get expensive. Right now, we are moving further away because the market is so strong, away from the highways that the market normally travels in. It's always higher or lower. When we crashed and burned on those 7 days in December, we were way off the highways. I told you we would bounce. One with the other, we would bounce. And boy, was I right. You all know that. December 24th felt like Armageddon. Never in the history of the United States have the markets crashed 680 some points on the Dow Jones Industrial Average a day before Christmas, on Christmas Eve. Nope, it did happen. So what happened after that? See you later. We had a 1,000-point day almost the day after, right? Yeah, or 500 points. Anyway, so bottom line is, this is getting stretched. That means we're getting very overbought. People are starting to get excited. Some people are. They're going to come in at the top in the overall market. Now, selective stocks will do separate things. That's a different story. But I'm talking the overall market. So the machines will blast them. And technically speaking, this is a rising wedge, and rising wedges always correct. Now, whether they correct from here or whether they correct from here right away, we should determine. But this pattern looks like it wants to bust a move here. And then we get a nice pullback, the galloping horse pattern. Remember, rising wedges, and if the primary trend stays intact, the key line that you guys all have to watch for on this chart, somebody step up and tell me. I've already marked it. What is the level of critical support on this chart right here? Because if you don't understand my charts, you're just going to keep on losing money. Come on, it's right there. It's staring at you guys.
29.50. 52.
Thank you. Thank you, Jody, for saving me from the anxiety of waiting, like who's going to speak up. Come on, guys. All right. Thank you, Jody. All right. There's this line. Can't make it any more easier. Like I love saying, not to offend anybody. But even a child can read this chart. Seriously. Actually, kids would read this chart better. So right there, 29.50. You're absolutely correct, sir. Thank you. That also happens to be the rising beautiful blue line, which is the 20-day moving average. And I think we do test 29.50. Gaps get filled. Now, there is another gap here. There is another gap here, minor one, right there. That's around 29.82. That will be the first level of a pullback. Remember, every point the S&P pulls back is roughly 7 to 9 Dow points. Do not get freaked out. Of course, you can't get freaked out because I'm always there, being the commander-in-chief in this battle of trading. And every 15 minutes, every 20 minutes, every half hour, there's a chart, there's a comment, there's something. So you guys keep your head straight. Try to work on your head, okay? So yes, so the gap will get filled. When? Don't know yet. I would say within the next 10 days. Let's get a washout. Now, we do have the crossover of the 34 and the 50. That's beautiful. That is really beautiful. Why is it beautiful? Because it makes people money. Makes smart tactical traders money. Forget about the people. That's it. But now we're quite overstretched. Now, internals and stuff are all very nice. Remember, we can get really overbought and hit that 3,100 plus level, up 700 points. And at that point, the last remnants of the bears will turn bullish. Not us. We, at that point, will be tactically bearish. Just remember that. Because price chasing traders, which are the 90% of traders out there, are always looking at price movements without looking at internals, without looking at the structures and stuff like that. So does price determine where things are going to go? No, not really. It's the structure of the price that determines. So that's your market overall. What I expect. I expect the markets, and the earnings season is very critical. We get a couple of slew of really bad guidance from these big boys. We're going to be testing this gap like very soon, like within days. Citicorp is very important. One of the things that might hurt them is this low interest rate environment, but let's see. Netflix is the stock du jour for I wouldn't say for all internet sucks. Netflix is a streaming company. And this is going to be a big, big mover, right? Big mover. We're going to play straddles on Netflix with a long bias. Technically, Netflix, we have done very well on this, would be a screaming buy. And even though I bought a little bit on Friday, I want to really get into a nice Netflix position. I want Netflix to really collapse before earnings on Wednesday and set up for a big move on earnings. That's the way you all should think. If you're looking to buy a stock, do you want to buy it like as it's making new highs? Yeah, technically you do want to buy a stock making new highs because it's going to go a little bit higher. Or do you want to have it pull back before earnings and it gets cheap on a technical basis? The answer is simple, ladies and gentlemen. You want it cheaper. The average immature amateur trader thinks, oh, I'm going to buy this stock, it's keep on going higher before earnings. No. You want it down before earnings. So what would be down for Netflix? And please do answer, including Jody. We have something happening in Netflix that's happened in S&P 500, and I had shown you guys that before the big blast off happened. We are seeing what here? And I'm literally spoon feeding you guys. What is happening here?
We have a crossover.
Don't just say crossover. Crossover of what?
Sorry, I'm on a phone, so I can't really say the averages.
Yeah. So what are the averages that we look for in a crossover? I just said that it's like a few minutes ago.
Probably 34 and
yeah, not probably. You should know by now. The 34 and the 50. Those are the major ones. So yes, thank you. So bottom line is we are about to do the crossover. Right there. That's brilliant. Now, while the crossover is happening, the stock on the external side, on the candles, is pulling back. Love it. You got the internal. That's called a positive divergence. We have a nice crossover beginning. And in the meantime, the stock was quite overbought, i.e. the distance traveled, the standard deviation was probably 5 to 7 away from the moving averages, which are the highways the stock should travel in. So bottom line in simple English, the best, what would be the really powerful, what would be the ultimate buying point in Netflix before earnings? I want people to look at it and tell me.
$368.
That's the first one. Excellent. And what would be the ultimate buying?
50.
Speak up, please.
361.27.
What is it?
361.
Thank you. Now you wonder why Jody makes decent money overall. In fact, very decent money. That's it. Anybody can understand this. You have the crossover right here at 361. I have a line drawn here, which I will enhance. Thank you for both of you for responding. So we would be looking 357.83 on a panic, like sell, and all these BS hardcore Netflix hating guys like, oh, Netflix never makes money, just the way Amazon never made money. What, 4 years ago, till they showed how much money they made on AWS and Amazon Web Services, and the stock jumped 500 points. I mean, come on, Netflix can turn the thing and say and show a lot of profit too. Yes, they're spending a lot of money on content. I was never a binge watcher on any shows. And within the past year, I've seen some unbelievable shows on Netflix. Like from like 12 till 2 in the morning, I'll be like watching like one of these shows, like boom, finish off the whole thing. You know, Netflix is pretty amazing. So, and again, I'm not in love with Netflix. I'm simply saying that from a technical standpoint, yes, we would want to be buyers here in a big way. Now the candle structure is showing a pullback. So this is a rising wedge. This is your consolidation. The stock has dropped from the level that I said it would go to, but it hasn't broken out yet. So we'll look at the bigger picture, the 384, 385 level. And now it's consolidating. And the first level of thing will be 370.28 support. Then you have the blue line here at 369, same as 370. And then you have the 34 and the 50-day moving average around 361. This would be the point where we really want to buy in a decent amount. Will it get there? I don't know. I'd like to see it get there. But if the market croaks before Wednesday, then Netflix can get to 361 from 373. That means it's a $10 move down. It's going to be very quick. It's good. The windows of opportunity on these type of stocks, and of course the overall market, but the windows of opportunity that these stocks give you to buy them are very small. What do I mean by that? It means that they give you a couple of hours maybe, or maybe an hour, or maybe a day at the max. So if you're not in there, you ain't going to get these moves. This one lasted one day, where the stock basically hit that major resistance at 375, and then it dropped fast to 358. Of course, the market croaked that day too. This was back on the 25th of June. It gave you one day, couple of hours to get in there. We did, or just not make money. Because if you bought around these levels, as it was testing the red line and it tested both the 34 and the 50-day moving average simultaneously. I'm sorry, it tested the 50-day moving average. 34 was down here. And the downtrend line. Remember, this is a downtrend line. You got to understand downtrend lines and uptrend lines. I mean, it cannot be any more easier. So if you didn't get in there, as it tested the 50-day and the downtrend line, perfect scenario. What we call in the business the perfect moments, the perfect technical moments, not the emotional garbage perfect moments. There are no perfect moments in emotional trading. So if you bought it there, it was slightly around, it was around 358, you would have made a shitload, crap load of dollars just within the next couple of days. A lot. Just the way the Amazon calls, that went from 7 to almost 70 in 4 days. That, by the way, is also explained very well in this morning's session that Jill attended and a couple of other people. Appreciate that. So please review that, because it shows like clearly the strike prices and how it happened and blah, blah, blah. So that's it. So Netflix, this is your short-term picture. Now, the bears will say, hey, looks like it's doing this pattern. It's going to go all the way to 348. Hey, they might be right. Netflix might say, hey, all our shows suck. We're not making any money. The Chinese are hacking us. The North Koreans are hacking us. The Russians hate us. You know, they could say whatever. But just giving you the technical thing as to where the stock would be a more opportunistic buy. Even here it's an opportunistic buy, because it could very well turn around after touching it in the first 10-15 minutes of trading, the 368 level, and then make a move higher. Remember, there's a bunch of hedge funds which are short Netflix, and that's the reason why the stock moves like this. When they start getting blasted, see you later. Now, this is your chart on Netflix on the weekly, and this is the one that I focus on from a swing perspective. Let me get this line out, get the falling wedge here. This is your channel. Let me get this out, edit properties, put it on the left. Perfect. We are starting to see an actual crossover. Very interesting on the weekly. Guys, these are big money trades. With small money, you can make big money. Remember, we're a capitalist country. We're not a bunch of left-wing socialists, all right, overall. So when people say, oh, I don't have much money, you know, I can't really make money in trading, you know, I said, don't give me that garbage. With $100, when you put $300 and it goes to, you know, $1,000, $2,000 on these lotto trades, you don't sit here and do a song and dance about how poor you are. Okay? So, Ana Ocasio-Cortez here, whatever her name is. So, and she's very smart, by the way. So bottom line is that time to wake up and take some options risk. So the key is, this is exciting. So this is just starting to happen. Very, very important. Now, we are quite overextended. You can see that. The candle structure is very nice. Remember, overextension means that the standard deviation is very high, we're overbought. Internals are very nice. Let's look at the internal. What is internal health saying? Internal health is saying, you know what? We're not even overbought yet because we get overbought between 100 and 90. We're just getting to get in that stage. So what does this mean to me as somebody who's shown this repeatedly during earnings season? Yes, the stock might pull back the next day, whatever, but then they're going to pick it up and run it higher. Or overnight it might be down, opens down up next day, opens down next day on Thursday. They pick it up and they just run it. Called a reversal trade. And you do not want to short a stock like Netflix on a reversal trade. No, you don't. So this is great. This is when it gets really overbought like it did back here, and it pulled back 30, 40 points. And then it started to slide down, which caused a overall pullback in Netflix back towards the 340 level. So here it's telling us that on a weekly basis for swing traders, it is not overbought. That means the stock is going higher. Unless this crashes and completely turns around, the stock is going higher. The full stochastics and the stochastics are the best way. You don't need to even think, you don't need to basically overthink. They'll tell you what happens. This is the 1 hour chart. So obviously, this will be quite choppy. So let's look at the weekly, ladies and gentlemen. All right. So weekly, the candle structure overall is pretty good. I need to adjust these lines for the weekly. I would rather draw it like this. Yep, exactly. And this is your, move some lines, clean this out a little bit. So you can see here, it hit, it is trying to enter. On the weekly, the rising wedge is higher. Does everyone see that? Does everyone see that? If you don't, please tell me. Great. So the rising wedge on the weekly is between $388 and $412. We haven't even entered it. It tries to keep on getting there, but entering a rising wedge is, you're hitting major resistance. And that's the reason why the stock is moving in this sideways band, which is a very large inverted head and shoulder cup and handle. Upper end of the handle is 385. That's why Josh Brown on CNBC keeps on always talking about. Remember, he keeps on saying he's a pretty smart guy overall, and he's funny. So he says if the stock significantly breaks out over 385, confirmed breakout through the big bullish candle, whatever, that's when you buy it. Okay, fine. But we at Clueless Day Trading tend to buy setups well before it's obvious to everybody else. In life, when is the real big money made? When the rest of the world is just catching on. Because if everybody sees the same thing, it's already there. That's why Warren Buffett, the ultimate American investing icon, richest man in the world, one of them, says you pay a very high price for certainty, which in simple English means that by the time everybody knows and sees the same thing, the stock price is already up there. We at Clueless Day Trading tend to be more speculative and predictive. We predict what might happen. So the lower end of this band is 340. Upper end of the band is 385. Everybody knows when that breakout's going to happen. They're all going to jump in then. Do you think you're going to make a lot of money on that? The algos will most probably, the minute it hits this rising wedge thing here at around 390, they'll probably unleash a major sell program, which will create a nice little consolidation channel where your profits are going to get wiped out and you're going to be crying because you are too late. And the people waiting for that breakout didn't have time to react. They'll be rushing in to buy because all these pundits have told you that if it breaks out of a range, it's going to go higher, which it will. But initially, the algos know that's how everyone's thinking, so they'll basically smash you. It's pretty simple. Got to think differently, all right? So I would say that overall, everything is good. If the stock does break out of the range, it will initially unleash a big sell program back towards 380. After that, it will basically get up there. But what I'm simply showing you is that on the overall picture, the all-time high of 420 plus and the the rising wedge at at 414, 412, and the entrance into this rising wedge is 391, which is a significant resistance, 386 to 391. So Netflix looks pretty damn good to me. I'd play a straddle on the earnings, or I would, if somebody's really bullish on it, friggin' buy some 400, 420 calls. Because if this stock really moves, the movement on this stock, let me see what the implied volatility is if they're showing it. The implied volatility on Netflix means what the over average move plus minus would be. Why do I do this? I'm looking at my other screen. Hold on. It's $24. $24. Stock closed at 373. What's 24 plus 373? It's 397, which is up here. Or it's a drop of 24 from the close at 373, which is what? 373 minus 24 is 349. Right there. See? There's your 349. It'll retest the downtrend line and attempt to bounce from here. And these lines have already been drawn in advance. So either it's going to go up. That's what the options players, that's the implied volatility showing on Thinkorswim, is $24. My opinion, if they deliver strong numbers or the guidance is good, their expense control is fine, and all that stuff, because Netflix is, borrowing a lot of money for their content and stuff like that. So there are reasons to worry here and there. Is the fact that it can go far above 25, or it can fall below this line and head towards the 337 level, which is where you'd want to be a serious buyer if the stock collapses. Any questions?
No.
No.
All right. The other one that comes
Nope.
to mind, okay, sounds good. The other one that comes to mind is Goldman Sachs, all right? So these are the two major players. On the one is the tech side, and one is obviously the financial side, investment banking side. Now, first glance, when you look at the Netflix chart that I just showed you, and this, they look totally different. Yes or no?
Mm-hmm.
Totally. This chart looks freaking amazing. Netflix chart, I have some questions on it. You know what I'm saying? This chart is just, it's first of all, it's way off the highs. This is Goldman Sachs, by the way. It is a massive, and going back to December, August of 2017. Wow. Massive macro head and shoulder cup. Here's your handle. What happened to Goldman Sachs this week? Look at this. This is your cup. 1 second. It's very obvious, guys, okay? There's your massive handle.
It broke out.
Or what we call the trading range. It broke out. In fact, this is the first time I'm seeing it on the weekly. Even though I trade Goldman here and there, this is very significant, ladies and gentlemen. You want frigging free money coming into your pocket? Buy these frigging charts. And buy them with some size so you make some real money and you move on to that different level of mental and trading confidence that we all strive to be at, where you can talk with confidence, where you can look at a chart with confidence and you can say, yeah, I'm going to make money on this, instead of always playing defense. That's what the rest of the world's doing. That's what the hedge funds are doing. That's what a significant amount of institutional fund managers are doing, always playing defense. There are very few serious money managers with billions of dollars under management who are playing offense. I'm sure you all understand playing defense and offense. Nobody's playing offense in this market. Nobody's bullish. You look at a chart like this, it's frigging amazing. And I'll share it with you. It's the first time I'm seeing a weekly chart on Thinkorswim on Goldman Sachs. This is a significant breakout. So what's the simplest way of looking at it? This was your upper end of the range, that number. And I had called this an ascending triangle weeks ago, if you remember. That was a ascending triangle on the daily. That's why that title is still there. This is a cup and handle overall with a neckline. Off. First neckline breakout is happening now. 210. Excuse me. The next neckline comes into play, if you want to be very specific, at 222. The ultimate neckline comes into play at 232 by 245. Ladies and gentlemen, Goldman Sachs options are pretty cheap. And if there was no China trade war and all this garbage going on right now, I would be buying heavy, long-dated calls going out a month or so, or going out even 2 or 3 weeks in the 230, 240 range, which would be dirt cheap in the dollar plus range, and taking out $6, $7 as the stock goes towards each of these technical moves. But market's a very uncertain place. Hold on one second. So you want to play it a little bit more, not defensive, but a little bit more controlled, then buy the weekly calls a little bit at a time and let the trend develop. Then you would pedal to the metal and we move from there. But this is extremely bullish. Now, what's the lower end of this range? Somebody tell me, what's this number here? Jill, asking you, because I want Jill to learn. Jill, what is this number here?
180.
Thank you. That is the lower end of the range. Jill, by the way, is very new to trading, ladies and gentlemen. She's very quick in learning, and I can bet you in about a month or two after she does all these sessions and she takes some coaching sessions and stuff, she's probably going to beat the pants out of all of us in trading. I'm telling you right now. My bet's on you, Jill, all right? That's serious.
Awesome.
Yes,
Thank you.
I'm serious. You got to keep mentally be prepared. You're new. The first thing I asked Jill when we had the initial conversation, how long you been trading? She said 4 or 5 months. I said, that is fantastic. That means she doesn't carry garbage and baggage, mental baggage from years of trading like most traders do. That's what stops us from learning the new way of trading and investing, which we teach here at Clueless Aid Trading. So make yourself proud, make your family money, and make us proud and make Clueless Aid Trading like a star. You can do it, Jill. All right? You can do it. So, and this is the way you learn how to look at markets in a very technical way. So let's move on. So you got 210, you got 180. What? And I want Jill to answer this. So Jill, what is the trading range here? Between 180 and 210.
Like where you would buy in at?
That's not my question. Listen to a simple question. What is the trading range? What's the difference between 210 and 180? What is the width of this channel?
30.
Thank you. Thank you. There you go. 30. So the depth of this channel, the width of the channel
You
is...
didn't know that, nigga.
Okay, please. Don't be doing the nigga stuff here on my webinar, okay? I understand what you're saying. I know it's your boyfriend or whatever. Okay, so you got 30 points here, Jill. You know that. So what you do is you add the 30 to the 210 and you arrive at 240, which also happens to be this dotted line that I had drawn weeks ago, which is your neckline. The stock, most probably, on some solid earnings and stuff, will go to 240. So what you do is you look at a trading range of a stock that has been going on since February of and January of 2019. That's 30 points. Okay, you add that 30 to the breakout. One way or the other, over a few weeks, not days, over a few weeks, the stock will get towards that level, 240. This is a good looking chart. It's going, you got a trading range here of 30 points. That's your depth. Once, now that it's broken out, yeah, it can pull back a little bit here and there, but if things go and if keeping on expanding this candle, the stock first going to hit 230. That's going to be some big sell programs come in, and then it's going to head towards the 240 level or so. That's a simple back of the napkin type of calculation, just so you all understand. Okay, so Goldman Sachs is in the picture. Now, if things go completely wrong and the stock basically talks garbage on earnings and crap happens, then the stock will at that point come down and retest 193. But so far, it's looking good. On that note, ladies and gentlemen, it was a pleasure. Jill, Jody, MB, Mike, Trina, and I didn't miss anybody. And everyone else who's going to listen to this, just make it happen. All right? Just stop being scared. And if you're really scared because the market opens down and positions are upside down, let me just put it this way. Take a deep breath, feel your breathing. I mean that, all right? Seriously. Sit there. I don't care how much money you're trading with. You can always grow your account. It's how you deal with it. And excuses of, oh, I'm too busy, I can't watch the charts and stuff that we get from some members who cancel here and there, I tell them that's hogwash. You want to live in a world full of excuses? I have shown more swing trades that have lasted weeks that have made 3, 4, 5, 6, 700% in options. So that excuse is garbage. So let's keep the excuses aside, and I'm talking to all of us, including myself. Let's move on. We're in earnings season. This is going to be a blockbuster season with some real ones that just explode higher, some that are going to crash and burn and then turn around. Track the charts, get ready for volatility, and always thank God for every day He gives us. Have a great evening, Dave. See you guys tomorrow.